If you're thinking about investing but don't really know where to begin, Alan Lancz is with us this afternoon to help out. He's a nationally known investment advisor from Lancz Associates. Good to see you again. It's been a while. We first met during COVID. I was doing weekly financial updates and with a whole variety of people in the profession. And you were saying at that time that the economy had tanked because of the lockdowns. You were saying that it'll bounce back, and years from now it'll really be just a small blip on the screen. And you were right, because the Dow Jones just set all three indexes just set records this past week, and it just keeps going higher and higher and higher. How much higher could it keep going?
Well, that's the interesting thing, Dan, is I learned from my mentor, Sir John Templeton, you buy when there's blood on the streets, and COVID, everything was negative. Prices were down, and it was a great time to buy. We did some national publications where he said the next 45 days is critical. If they start opening up again, we're going to get back to normal, and that's exactly what happened. Now you're going to get the other end of the coin. Everything's been up. We talked about higher, for longer with interest rates. We're not going to have 6 cuts like everybody was talking about in 2024. We're lucky if we're going to have 1 or 2 by the end of this year, and all be in the latter part of the year. So it's a situation where everything has gone up, but bonds, and you can get still 5.5% on your cash, CDs, treasury bills, where you don't pay city or local taxes. So you got some options now that you didn't when we first met.
Why were bonds down so much as stocks were going up?
Good question, and that's because bonds, it was an environment where interest rates went down for so long. They went almost negative here in this country, and they were negative in a lot of countries. So if interest rates go down, bonds do well. Well, what happens when they're negative or close to negative, like we had 1% and less? The only trend is going to be up. There's only one way to go, and that's what's happened. So people have lost money in bonds that thought they were safe, and that's probably the biggest thing you can get out of investing right now is don't invest in areas traditionally that you think are safe. Understand the risk before you invest.
Explain what bonds are.
So bonds are a debt instrument, and it could be anywhere from months to years. And where stock is ownership, you own equity in the company, bonds are just purely debt. So if you're buying T-bills, it's debt from the government. So the government will just print money. You'll have, as far as a return on your money if you hold it until the bond matures. The problem is if interest rates go up, while you bought a 3% bond and now interest rates are 5%, you're going to lose money in your bonds if you're cashing out.
Well, interest rates should be going down from here on out, hopefully.
Yeah, that's the thing now. I think bonds are okay. It's still not one of our ideal investments. I'd rather do utilities because you have a peripheral play with AI and things we talked about last time, where the market will still be fueled by tech for at least most of this year. And energy needed to make those semiconductors, and then energy to produce and keep going those language models. And utilities have done nothing for 5 years, so you bought them cheap, just like in 2020, buying the general market cheap, and you've got a good income while you wait. And utilities are actually leading. The last month they were up like 14%. It's incredible. They usually don't do that in 2 years.
You go back, let's say 10 years, chips weren't that big of a deal. Mm-hmm. Now with AI, NVIDIA is like the hot company. Their stock's been up 200% the last 12 months. It's just insane. Is tech the way to go with investing now?
Well, again, now you're getting to a point, we love tech. Last time we were on, you asked about AI, I said it's for real and definitely invest in tech. Now you get these things, they're up 200%, they tripled, right? And it's a situation where I wouldn't chase it. It's a volatile stock, so they're coming out with earnings tomorrow. So if you get that volatility, buy it. At least, if you don't own any, buy any on weakness, and don't chase up unless you understand the risk.
And one more thing, green energy, where is that as far as making money? Is that a failed prospect, or is that something to keep an eye on in the future?
I think it'll be okay. Like Tesla and Apple were the only 2 Mag 7 stocks that led the markets these last 3 years that are down. Apple's now recovered, so it's up for the year, but Tesla's still down. But in the long run, I think Tesla will be fine. But again, you're buying on weakness. So those are things to look at now, that haven't done that well. It's just like utilities, a month ago.
It's remarkable that Amazon was a company that was started out like doing some home entertainment and then doing the home shopping, and now all of us. It's just part of our everyday life is ordering stuff on Amazon. It's amazing a company can have warehouses full of every single product made. You can get it in like 24 hours or 2 days.
And you've got that tech component with AWS and their cloud,
Yeah.
you know, like Azure with Microsoft, and that is going to be fueled with AI. So we really like Microsoft and Amazon, even though we're not chasing them. Those are two of our biggest holdings.
So you cannot go wrong with tech these days in the future.
Yeah, as long as you're not chasing it. I mean, you buy it and hold it, you know, but, you know, I wouldn't chase it. But, you know, those high quality companies, if you don't own them, yeah, I'd buy them.
Okay. Alan, good to talk with you as always, and we'll see how, we'll have you back here in a few months, and because the world just evolves and so does the financial sector.
Oh, it's volatile, so yeah, that's when you can take your chances and buy into weakness. You don't have to chase things and be a disciplined investor.
Appreciate it. Thanks, Alan.
My pleasure.